Did you know there's a financial system operating quietly in the background of your life? It's an invisible framework the wealthy understand and use every single day. You were never taught this in school. In fact, most people are guided away from ever discovering it, pushed instead toward a path filled with friction, limitations, and diminishing returns. But once you truly see how this system works, you can never unsee it. What if the financial pressure you feel isn't because you're not working hard enough, but because you're participating in a game designed for you to lose? And what if there were a legal way to step out of that game and into the one played by the top 1%? The economy isn't one unified playing field with a single set of rules. It's split into two separate worlds, each governed by a completely different operating system. The first world is the world of the employee, the high-income earner. In this world, the cycle is simple: earn, get taxed, then spend whatever remains. It's a world built on friction. The second world is the world of the owner. Here, the cycle is leverage, compounding, and strategic tax avoidance. The line dividing these worlds has nothing to do with intelligence or effort. It comes down to one key distinction: income versus equity. To understand why the wealthy use the buy, borrow, die strategy and why the tax system actually benefits from you not knowing about it, we must first break the illusion of income and rebuild your understanding of wealth from the ground up. The majority of people believe wealth comes from high salaries. They chase promotions, overtime, and bonuses, assuming larger paychecks equal financial freedom. This belief is the core trap of the first economic system. The tax code wasn't designed for workers. It was designed to reward owners. The moment you move from earner to owner, even through a single rental property or a small stock portfolio, you begin playing by an entirely different set of rules. This is the owner's playbook, a quiet, fundamental system the wealthy use not just to become rich, but to stay rich indefinitely and compound their wealth far beyond what most people imagine possible. To see why the wealthy play a different game, we must first understand the rat race. For most people, financial life revolves around the amount that hits their bank account each month. You trade your time for money, and that money is taxed immediately. In the US, high earners can lose up to 37% of their income to federal taxes alone. Add state, payroll, and sales tax, and a huge chunk of your labor disappears before you can even begin building wealth. This is a system designed to drain you, slowly, like running a race with a backpack full of rocks. This explains a strange pattern among billionaire founders like Elon Musk, Jeff Bezos, and Mark Zuckerberg. For years, many of them famously took a salary of just $1. This isn't humility, it's efficiency. They avoid income because income is the most heavily taxed form of money. Instead, they focus on equity, shares in their companies, real estate, and other appreciating assets. This strategy relies on a key quirk in the tax code, known as the realization principle. You do not owe taxes on the growth of an asset until you sell it. The buy, borrow, die strategy begins right here. Cash is not the goal in fact. To the wealthy, cash is a liability because inflation constantly erodes its purchasing power. Instead, they seek assets that do three things simultaneously. 1. Generate cash flow like rent or dividends. 2. Appreciate in value over time. And 3. Provide tax advantages like write-offs and depreciation. For everyday investors, the most accessible vehicle for this strategy is real estate. It's an asset class that naturally hedges against inflation and provides solid collateral that banks understand and trust. This brings us to a crucial mindset shift. The wealthy prioritize lendability. Consumers ask, "Do I want this?" Owners ask, "Will a bank lend against this?" Real estate, stocks, and bonds are lendable. A new, depreciating car is not. While workers save money to buy liabilities that drain their wallets, owners buy assets that fill their wallets. Their equity becomes the engine that powers everything else, the goose that lays the golden eggs. Workers consume the goose. Owners protect it at all costs. Now, let's consider the math of accumulation. Saving $50,000 in a bank account earning 1% is actually losing you money when inflation is at 3 or 4%. But using that same $50,000 as a down payment on a $250,000 rental property gives you control over an asset 5 times larger. A 5% increase in that property's value isn't just 5% of your down payment. It's $12,500. Which is 5% of the entire property's value. This is the power of leverage in action. The accumulation phase is all about building a fortress of collateral, your own personal bank. Once you've built a portfolio of appreciating assets, the next logical question arises. How do you pay for your lifestyle? This brings us to phase 2 of the strategy: borrowing for liquidity. If a billionaire refuses to sell their assets because selling triggers taxes, how do they fund their life? This is where the two worlds of debt collide. The middle class sees debt as dangerous because they primarily use consumer debt credit cards with 25% interest used on items that lose value instantly. Meanwhile, the wealthy use what's known as systemic debt, which is borrowing against their assets to access tax-free money. You see, borrowed money is not income. It's not taxed. It simply appears in your bank account with zero friction. Imagine a wealthy person with $10 million in Amazon stock who needs $200,000 for their living expenses this year. They have two options. Option 1. Sell the stock. To get their $200,000, they would have to sell a portion of their shares. Let's assume a combined capital gains tax rate of 30%. To net $200,000, they'd actually need to sell around $285,000 worth of stock. They instantly lose $85,000 to taxes, and more importantly, they've reduced their compounding base forever. Now for option 2. Borrow against the stock. Because they have $10 million in liquid assets, banks view them as extremely low risk. They can take out a securities-backed line of credit at a low interest rate, maybe 4 or 5%. They borrow the $200,000 they need, completely tax-free. Their full $10 million portfolio stays invested and continues to grow. If that portfolio grows by just 8% that year, the growth alone more than covers the interest on the loan, and their net worth continues to climb. This is the secret. They live off of interest, tax-free loans secured by their appreciating assets, allowing their wealth to compound uninterrupted. They have unlocked a powerful financial engine that most people don't even know exists. It's not about being smarter or working harder. It's about understanding the rules of a different game. By shifting your focus from earning income to building equity, you can start playing that game too. Thanks for watching. If this opened your eyes to a new way of thinking about wealth, hit that subscribe button for more insights into the owner's playbook. See you in the next one.